Celsius stock is reporting earnings November 6th before the market opened. The stock is up 115% year to date. So let's find out if this is a good opportunity to buy the company by looking at the fundamentals and running a discounted cash flow model to calculate the intrinsic value of the company and potential future returns. Starting with their financials, Celsius revenue has seen massive growth in the past decade, growing from $17 million to $1.6 billion currently. We can also see that revenue growth has been a bit inconsistent, as the company has seen mainly massive growth from 2022 to 2023 and from 2024 to 2025. Analysts are expecting this growth to continue. They expect Celsius to grow revenue 84% this year and reach $2.5 billion, and then reach $4.3 billion in 2029. I agree with this positive outlook because they have a lot of catalysts ahead. They have become a leader in the energy drink space. They contributed 24.5% of all energy drink category growth in 2025. The number 3 energy drink in the US with total US share of 16.8%. And they have managed to achieve this by creating a healthy energy drink. And while revenue in North America has decreased almost 8% this year, it has grown by 34% in Europe, 28% in the rest of the world, and 73% in Asia. Regarding profit, Celsius turned profitable in 2023, and they made $226 million in net income. However, since then, net income has taken a hit, and it is currently at $131 million. But one thing that I like about Celsius is that they have more free cash flow, which is currently at $210 million. Analysts expect profit to grow. In terms of EPS, they are expected to make $1.15 per share this year and grow to $2.44 per share by 2029. I also agree with this outlook because Celsius has great margins. Gross margin is currently 50%, profit margin 5%, and free cash flow margin 12%. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And according to my low assumptions, the intrinsic value is $17 per share, middle $31, and high $52. And because the stock is currently trading at around $58 per share, this means that if my low assumptions occur, you will get a negative 9.8% annual return on your money, middle negative 0.8%, and high positive 7.8%. As far as my assumptions, I assume Celsius grow revenue annually between 8 and 16% over the next 7 years, the average of profit margin and free cash flow margin between 12 and 20%, and I assign the opinion price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I'm going to leave a link in the description down below. The spreadsheet is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Celsius is trading at a P of 152 and price to free cash flow of 73, and therefore I think we can conclude that the company is trading expensive. But a positive aspect is their balance sheet, as they have $615 million in cash and $896 in debt, which is manageable for a company that has a market cap of $15 billion. In conclusion, I believe Celsius is a great company that has innovated in the energy drink sector, and while I believe there is still a lot of room for growth left, the valuation does not justify it. The stock seems very expensive, and if you buy a great company at an expensive price, it becomes a bad investment. In fact, I made a video about a year ago when the stock was trading at around $30 per share, saying that I believed it was a good investment because of the valuation. Lastly, if you want a discount on stockanalysis.com, the best place I've found for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Celsius stock in the comments, and I'll see you in the next one.